He will read some opening remarks, and then we'll go straight to your questions. Go ahead, Governor.
Thank you, Louise, and good morning. And thank you all for joining us to discuss today's policy decision and our monetary policy report. My message today is twofold. First, the economic outlook has improved, and Governing Council is more confident in the resilience of the economy to the pandemic. Canadian households and businesses are adapting to the virus, finding new ways to shop, serve customers, and work remotely. More important still, the rollout of vaccines is progressing, and we expect better times ahead. But second, most of Canada is now dealing with more contagious variants of the virus. La troisième vague a créé de nouvelles incertitudes et pèse sur les réseaux de la santé dans certaines régions. Cela va ralentir le retour au travail de nombreux travailleurs à faible revenu, les jeunes, les femmes, qui gagnent leur vie dans les secteurs où la distanciation est difficile. Ces secteurs ont été parmi les plus touchés par les pertes d'emploi durant la pandémie. Trop de Canadiennes et Canadiens sont toujours sans emploi. Il reste une grande marge de capacité excédentaire dans l'économie. I understand how difficult this third wave is for Canadians hoping to return to work and for businesses struggling to cope with new restrictions. I know the toll has been immense, and this latest wave is tough. You can be sure the Bank of Canada will continue to support Canadians and the Canadian economy through the full length of this recovery. Before I turn to the Governing Council's policy discussions, let me say a word about the format of the Monetary Policy Report. You'll notice two new boxes, boxes 2 and 3, that review changes to the global and Canadian economic outlooks. We added these boxes to enhance the transparency of our analysis and to more clearly explain our forecast changes. We intend to make these regular features of the Monetary Policy Report, so we look forward to your feedback to this innovation. Let me now turn to the Governing Council's deliberations. We spent a lot of time talking about incoming data. The first quarter is looking like it was considerably stronger than we were expecting back in January. Cette croissance est due en partie au contexte plus favorable à l'échelle mondiale, surtout aux États-Unis. La reprise américaine est soutenue par une vaccination rapide et des mesures de la relance budgétaire substantielles. Ces facteurs ont des retombées bénéfiques au Canada puisqu'elles font augmenter la demande d'exportation et les prix de produits de base. But the most important factor in the unexpected economic strength has been the resilience and adaptability of Canadian households and businesses. Lockdowns through the second wave had much less economic impact than they did through the first wave. And as restrictions were eased, the economy bounced back quickly with substantial job gains in February and March. The third wave is a new setback, and we can expect some of the job gains we've seen get reversed. But the performance of the economy in recent months has increased our confidence in the underlying strength of the recovery. Comme la vaccination avance, nous nous attendons à une forte croissance menée par la consommation durant la seconde moitié de l'année. Les mesures de relance budgétaire adoptées par les gouvernements fédéral et provincial vont contribuer aussi de manière importante à l'expansion. La croissance solide de la demande étrangère et les prix plus élevés des produits de base devraient provoquer un net rebond des exportations et des investissements des entreprises. Cela donnerait lieu à une reprise plus généralisée. Globalement, nous nous attendons maintenant à ce que l'économie croisse d'environ 6,5% cette année. Ensuite, la croissance va ralentir à peu près 3,75% en 2022 et 3,25% en 2023. You won't be surprised to hear that we also spent time discussing what's happening in the housing market. The pandemic has led to some unique circumstances. With so many households working and studying at home, we see many people wanting more space. And interest rates have been unusually low, making borrowing more affordable. While the resulting house price increases are rooted in fundamentals, we are seeing signs of extrapolative expectations and speculative behavior. Given elevated levels of household debt and the risks that households may overstretch in the face of rising housing prices, we welcome the recent proposal by the Superintendent of Financial Institutions to introduce a fixed floor to the minimum qualifying rate for uninsured mortgages. New measures just announced in the federal budget will also be helpful. We are watching developments in the housing market very closely, and we'll have more to say on this in our financial system review in May. The Governing Council also spent time discussing estimates of the amount of slack in the economy and the outlook for potential growth. While the economy, with the economy proving more resilient to the pandemic and vaccines rolling out, we are hopeful that there will be less labor market scarring and less lost capacity than we earlier feared. Bankruptcies have been low, and surveys of investment intentions, including our own Business Outlook survey, both suggest that many companies are speeding up investments in digital technologies. These factors are reflected in our decision to raise our estimate of the economy's potential output. But it bears stressing that considerable uncertainty surrounds our estimates of potential output. We have never seen a recession or a recovery like this one. The pandemic continues to have widely different impacts across sectors, businesses, and groups of workers. Further economic restrictions have affected both demand and supply, and this is making it more difficult to interpret economic signals. This all means that as the recovery continues, we will be paying attention to a broad spectrum of indicators of slack, including a range of labor market indicators. Bien sûr, nous avons aussi parlé des perspectives d'inflation. Nous savons qu'au cours des prochains mois, l'inflation va augmenter en raison des effets de glissement annuel. Ces effets montrent simplement l'incidence, un an plus tard, de la chute de certains prix au début de la pandémie. Mis ensemble avec une nouvelle hausse des prix de l'essence, l'inflation devrait monter temporairement autour de la limite supérieure de la fourchette cible qui va à 1 à 3 %. Le Conseil de direction fait abstraction de cette montée passagère. L'inflation devrait ralentir peu à peu vers 2 % durant la deuxième moitié de l'année et baisser encore plus en raison des capacités excédentaires dans l'économie. Quand ces capacités vont résorber au cours de la deuxième moitié de 2022, l'inflation devrait retourner à 2 % de manière durable. Taking into account the improved economic outlook and the considerable slack that remains, Governing Council judged that the recovery still needs extraordinary support from monetary policy. We remain committed to holding the interest rate at the effective lower bound until economic slack is absorbed so that the 2% inflation target is sustainably achieved. Based on the bank's latest projection, this is now expected to happen sometime in the second half of 2022. In the current context, though, there is considerable uncertainty about the timing, particularly in light of the complexities involved in assessing supply and demand that I mentioned earlier. Our forward guidance continues to be reinforced and supplemented by our quantitative easing, or QE, program. We decided to adjust the program to a target of $3 billion weekly net purchases of Government of Canada bonds. That's down from a minimum of $4 billion per week, while we will be maintaining broadly the same maturity composition of our purchases. This adjustment of the incremental stimulus being added each week is consistent with the progress toward economic recovery that we've already seen. Looking ahead, further adjustments in the pace of net purchases will be guided by our ongoing assessment of the strength and durability of the economic recovery. If the recovery evolves in line or stronger than our latest projection, the economy won't need as much QE stimulus over time. Further adjustments to our QE stimulus will be gradual, and we will be deliberate both in our assessment of incoming data and our communication of our analysis. Nous sommes déterminés à procurer le niveau de détente monétaire nécessaire pour soutenir la reprise et atteindre l'objectif d'inflation. We are committed to providing the appropriate degree of monetary policy stimulus to support the recovery and achieve our inflation target. And with that, let me stop and turn to your questions. Thank you.
Thank you, Governor. We'll do one question and one follow-up in this first round. When you do ask your question, please state your name and affiliation. I do want to remind people to mute their line if they're not asking a question. You can do so by pressing *6 and unmute by pressing *6 again. Avant de poser une question, veuillez vous identifier. Libre à vous de poser vos questions dans la langue officielle de votre choix. Pour mettre votre ligne en mode discrétion, appuyez sur l'étoile 6. Pour l'enlever, faites étoile 6 encore une fois. The first reporter in the queue is Julie Gordon from Reuters, and she'll be followed by Mark Rendell and Shelley Hagan. Go ahead, Julie.
Thank you, Louise. Hi, Governor. Julie Gordon from Reuters here. I'm just wondering, the NPR has included an impact of $85 billion in stimulus. That's actually come in at just over $101 billion, with nearly half of that front-loaded into the current fiscal year. How much will that impact your forecasts?
Well, good morning, Julie. We completed our projection before the budget, and so we had to make some assumptions. So the assumption that we put in our projection was $85 billion of new federal stimulus. That was the midpoint of the $70 to $100 billion range in the fall economic statement. What I would say is that, so obviously the budget has come out. There's roughly $100 billion of stimulus. Having said that, our projection at a macro level really captures the fiscal stimulus that has been announced both by provincial governments and to a large degree the federal government. Keep in mind that the difference between 85 and 100 is obviously 15 billion. That's spread out over 3 years. That's not a very big number. The other thing I would stress is that a number of the budget provisions are extended supports for workers, for households, for businesses, for renters. And that's a provision in the budget. How much actually gets spent will depend on the outturn for the economy. If the economy recovers well, people will be getting back to work, and all those supports will not be needed. On the other hand, if the economy turns out to be weaker, those supports the money will be spent. Those supports will be very important. The other thing I'd stress is that in assessing the macro impact of the budget, you have to look at the composition of the spending. And there are a number of initiatives or elements in the budget that will stimulate supply as much as demand. National daycare being an obvious example, but there are also others. There are some initiatives to accelerate investments in digital technologies by small and medium-sized companies. There are investments in education. Those will stimulate demand and supply together. And so the impact they'll have, by expanding both the supply capacity and demand, they'll have less impact on the inflation forecast. So, as I said, I'm confident that our projections really capture the broad brush of the fiscal stimulus in provincial and federal budgets.
Yes, thank you, Governor. And for my follow-up, can you give us an update on where things stand with your research into a central bank-backed digital currency? Do you expect to launch a pilot this year?
Well, thank you for that question. Tim Lane gave an important speech on this about a month ago, where he really laid out how our thinking and how our work is evolving. There's no question the pandemic has had many consequences. One of those is it's accelerating the digital economy, and in that context, a digital currency, the case for a digital currency becomes more compelling. We have not taken any decision. Ultimately, it's a decision of the Minister of Finance if we were to have a digital currency. But we are certainly accelerating our work to make sure that we would be in a position if that was something that was needed and beneficial in Canada.
Thank you. The next question is from Mark Rendell, Globe and Mail. Go ahead, Mark.
Hi, Governor Macklem. Can you hear me?
Yes, Mark, go ahead.
Perfect. Thanks for taking my question. When you're speaking about the evolution of slack in the economy, it mentions looking at a broad spectrum of indicators and various measures of labor market conditions. What exactly are we talking about there, and what, I guess, measures will you be looking at to measure that slack?
Well, it's hard to give you a long list, Mark. I think what we wanted to convey is that there is an unusual amount of uncertainty. In this outlook, we revised up our estimates of potential output. In the darkest days of the crisis, we pulled them down quite a bit. But with the economy proving more resilient, we're hopeful there'll be less labor market scarring. And with the recovery proceeding better than expected, we're starting to see more signs that firms are turning to investment. We know there's going to be some destruction of capacity from this crisis, particularly in the hardest hit sectors. But at the same time, we're seeing more investments in digital. We're seeing accelerated investments in digital technologies that will be adding to capacity. So, and we revised up our estimate of potential output. It's still a percentage point below where we had it before the pandemic. There's a lot of uncertainty. It's particularly hard to assess. It's always hard to assess the supply capacity of the economy. It's particularly hard in the current juncture where you're seeing, a recession and recovery like we've never experienced before, and where both demand and supply are getting affected. So it's more difficult to interpret our usual economic indicators. So with that in mind, we will be looking at a broader set of measures of capacity and slack in the economy. That includes a broad range of labor market indicators, as we've highlighted on a number of occasions. This pandemic is having very uneven effects on different parts of the labor market, particularly affecting low-wage workers, women, and youth. And so we will be looking at a broader set of indicators. We're looking for a complete recovery, and that's going to take some time. We will be assessing these various measures of slack on an ongoing basis as we move forward.
Great. Just for a follow-up question on quantitative easing, I noticed the language has changed. It no longer says the QE program will continue until the recovery is well underway. Does that mean you now assume the recovery is well underway? And what does that mean for the timing for the additional, tapering of the additional $3 billion?
Well, I think it means what it says. Today we took the decision to adjust our quantitative easing program to a target of $3 billion a week. And I want to stress that the decision to adjust the program reflected what we've seen in the economy to date. The economy has recovered better than expected. As I highlighted, the households and businesses have been impressively resilient to this second wave. The recovery has proceeded better than expected. And with that better than expected recovery, we don't need as much QE, and so we made that adjustment. Looking ahead, we will be, any further adjustments of our quantitative easing program will reflect our assessment of the strength of the recovery and its durability.
Thanks. The next question is from Shelley Hagan of Bloomberg, and she will be followed by Tony Mace, and Greg Quinn. Go ahead, Shelley.
Hi, Governor Macklem. I wanted to ask about more details on the tapering of the QE program. So you said the main reason was because of the economic recovery. Was there any technical reasons for reducing stimulus in regards to having too much of a share of the outstanding bond market? And then as well, what parts of the yield curve will the purchases be reduced?
Well, in the first part of your question, Shelley, the decision to adjust our QE program really reflects our assessment of how much quantitative easing stimulus the economy needs. And as I just outlined, it really reflects the progress in the recovery that we've already seen. With respect to your second question, the new target, $3 billion a week, down from the previous minimum of $4 billion, and we will be maintaining roughly the same composition of purchases across the yield curve.
And then when you moved forward your timeline in terms of when you see inflation returning sustainably to 2% and economic slack absorbed, you moved that up to the second half of 2022 from 2023. Does that mean that based on the current outlook, you would see a hike in the second half of 2022?
Shelley, let me first of all remind you that our forward guidance is outcome-based. We've indicated for some time that we're going to hold our policy rate at 0.25% until economic slack is absorbed so that our 2% inflation objective is sustainably achieved. That's a commitment not to do something. It's a commitment not to raise interest rates until those conditions are met. What we do when those conditions are met, we will have to assess that at that time. There's nothing mechanical. The other thing I'd stress is that our forward guidance is not calendar-based, it's outcome-based. At the same time, when we provide a forecast, we do indicate what our forward guidance implies relative to that forecast. And today we've revised up our outlook, and with a better outlook, the slack is absorbed sooner. And as we indicated in today's outlook, that happens sometime in the second half of 2022. I do want to underline the uncertainty around that. I spoke to that in one of the earlier questions. It really reflects this is a very unique cycle, and that is generating an unusual degree of uncertainty, particularly around assessing the evolution of the economy's supply capacity or potential output. And so, as I indicated previously, we will be looking at a broad spectrum of indicators. That includes a range of labor market indicators in assessing the degree of slack in the economy, and that assessment will be ongoing, and we will be providing our analysis to you. As we've said for some time, we're looking for a complete recovery. We're looking for a full recovery, and we're not going to count our chickens before they've hatched.
Thank you, Governor. The next question is from Tony Mace of Mace News.
Hi, Governor. It's Tony Mace here. I'd like to ask about the inflation outlook a little bit. It looks to me from the tables in the monetary policy report as if you are allowing for something of an overshoot of the CPI target going into 2023. To what extent are you looking to make up for the recent undershoot of inflation relative to target? And is this something like flexible average inflation targeting?
Tony, so yes, if you look at, I think it's chart 14 in the monetary policy report, there is a graph that gives our inflation forecast. And as you indicated, inflation does go a little bit above 2% in the later parts of the projection, basically into 2023. And that's really a consequence of our forward guidance. We've indicated we are going to hold our policy rate at the effective lower bound until slack is absorbed. And the consequence of that is that you're likely to get a bit inflation rising a little above 2%. After that, we have a band. We have a band of 1 to 3%, and it makes it. We put in place that exceptional forward guidance because we were in a situation where we had a huge amount of excess supply in the economy. Inflation was zero. In fact, it was negative for a little while. And our real concern was that inflation would be well below target, even a concern of deflation. So to really try and get the economy recovering as quickly as possible and get inflation back as quickly as possible against that background, we've provided this exceptional forward guidance. And as I said, a consequence of that is that the forecast is that inflation will likely go a little over 2%. That's part of flexible inflation targeting in a risk management framework where we really wanted the biggest risk was deflation, inflation being too low. We took out some insurance to get it back to target quickly, and the consequence of that is the forecast has a small overshoot.
Thank you. And just to follow up, if I may, please, you made some comments about the housing market earlier and some of the price pressures there. Could you expand on that a little bit more? Are you saying that enough has been done with the recent proposal for more stringent stress tests for borrowers?
Well, first of all, I want to say that we understand how difficult it is for some Canadians to break into the housing market. And if I need any reminder, I can tell you the correspondences I'm receiving from Canadians highlight the difficulties some Canadians are having in getting the home they are hoping for. With respect to the housing market, I think it's important to first of all reflect on there are many very unique features of the current cycle, and one of them is that we're all working at home. Our children are studying at home. Most of our recreation is at home. People want more space, and they're not commuting to work, and they expect that working arrangements are going to be more flexible going forward. They don't need to be as close to the city center. And so what we're seeing is strong demand for single-family homes, particularly outside of in suburbs and in communities surrounding the larger cities. That's real fundamental demand, and supply is not responding nearly as quickly as demand, and so you're starting to. We've seen rapid price increases. Our concern, our worry is that against a background of rapid price increases, people will extrapolate. They'll expect that those price increases will continue indefinitely, and they'll overstretch to buy houses. That would be a mistake. The proposal by OSFI to revise the B20 guidelines and put in place a minimum floor on the benchmark. That is a helpful proposal, and the reality is when interest rates are unusually low, there is greater potential for them to eventually rise, and so by putting in this minimum, that will help protect borrowers and lenders from overstretching. There's also a measure announced in the federal budget to put a 1% tax on vacant homes owned by foreigners. Again, that will tend to reduce speculation, and to the extent that foreigners are buying homes as an investment, it'll encourage them to rent those out, so that that will contribute to the supply in the market. those homes are not taken out of the market effectively. So, those are helpful measures. What I can tell you is, a couple of weeks ago, we put out some analysis of the housing market and the associated vulnerabilities. We will be putting out more analysis in our May financial system review.
Next question is from Greg Quinn of Market News.
Good morning. I want to amplify the question on housing a bit. People have cited not just the pandemic, but low for long interest rates as driving up home prices. Does the Bank of Canada not need to do anything here to help prevent any of the dangers in mortgage markets and housing markets?
Greg, I mean, look, there's no question, Greg, that low interest rates have made borrowing more affordable, and that helps people buy houses and increases the demand for houses. And there is this this combination of very unique circumstances where people really want more space, and interest rates, mortgage rates are low, which is making borrowing more affordable. Together, those are stimulating demand. With respect to monetary policy, Greg, monetary policy, it's a broad macro instrument, and we really need to look at the needs of the whole economy. The housing market is an important part of the economy. The housing market is built into our projection. When we look at the whole economy, there's still at least 500,000 Canadians who are out of work relative to the employment rate before the pandemic. There's considerable excess supply in the economy. Right now, the economy needs our support, and we are committed to providing the support the economy needs to support recovery and get inflation back to target. With respect to housing, our role particularly focuses on providing information and analysis. As I mentioned, we put out some analysis a couple of weeks ago. We will have more in our financial system review. This analysis should be helpful for Canadians taking decisions. It should be helpful for the financial community and lenders. And it's also helpful for other levels of government, OSFI, that play a role in this market.
Secondly, to go back to the bond purchases, one of your deputies mentioned a potential scenario where the size of the balance sheet became the target and not the pace of purchases. Is that a reasonable scenario? And how would kind of keeping a fixed size of assets on the Bank of Canada's balance sheet kind of aid in economic recovery?
Well, when you assess the stimulus from quantitative easing, you need to look at least three things. You need to look at the pace of the purchases, you need to look at the composition or the maturity structure of the purchases, and you need to look at the size of the balance sheet. So our decision today to adjust our quantitative easing to a target of $3 billion per week adjusts the pace. We're going to keep the maturity composition of our purchases roughly the same. What that adjustment means is that we will still be adding incremental stimulus. Our balance sheet will continue to grow, and so we are continuing to provide exceptional stimulus, and that's reflected really in the fact that our balance sheet will continue growing.
Thank you. The next question is from Jordan Press of Canadian Press, followed by Kim McCrail and Greg Bunnell.
Good morning, Governor. I wanted to just ask you to maybe elaborate a little more on what you said earlier, where you said we're looking for a complete recovery. And I'm wondering if you can explain what that means, particularly in the context of some of the groups you have mentioned are hardest hit through this pandemic, particularly women, youth, and low-wage workers.
Look, I think the message here is, we've made considerable progress. The outlook is better than expected, but there's still a long way to go. We have a lot of excess supply in the economy. Some important parts of the economy are very weak, and we have too many Canadians that are unemployed. We're looking for, so this recovery has some way to go. As we've indicated, the outlook is better. We are expecting that slack will now be absorbed sometime in the second half of 2022. But there is a lot of uncertainty about that. We will be looking at a broad range of indicators to assess this complete recovery. That's going to include a range of labor market indicators. As I've indicated, this pandemic is having very uneven effects in the labor market, particularly affecting low-wage workers, women, youth. There's a chart in the monetary policy report that shows that low-wage workers are at about 80% of their pre-pandemic level, or 20% below their pre-pandemic level. If you look at all other workers, they're actually back to their pre-pandemic level, which really highlights the very unevenness. So in assessing a complete recovery, we need to look at overall employment, and we need to look at that is a shared recovery.
And just as a follow-up, just to ask about housing a little more, you mentioned the budgets, the federal budget measure for the tax on vacant homes. Can you just explain a bit about how that can help keep some stock in the market? I'm wondering what can it not do in a sense that you feel maybe still should be done to help all those Canadians, as you said, who are writing you concerned about being able to afford a home?
Well, I guess for the details of the budget, you really need to speak to the Minister of Finance. But with respect to the 1% tax on vacant homes, if you go back to 2016, 2017, one of the things we saw is that, particularly in Vancouver and Toronto, there was some evidence that foreign purchases of homes were contributing to the large price increases we saw. And there's certainly some evidence that those homes were being purchased not to live in, they're being purchased as investments, and they're vacant. And the problem with that is that when you purchase a home and you leave it vacant, you're taking housing stock effectively out of the market. Nobody can live in it. A tax on vacant homes, what it'll do is, first of all, it'll probably dampen enthusiasm for speculative buying of homes. But to the extent that those homes are purchased, it'll encourage the owners to rent them out. So people are living in those homes, and they are contributing to the housing stock. They are contributing to the supply of housing. And what we're seeing in the market is that demand is running ahead of supply. A big part of the solution is to get supply to catch up with demand.
Thank you. The next question is from Kim McCrail of the Wall Street Journal. Go ahead, Kim.
Hi, thanks. My question actually will continue in the thread around housing. And I'm wondering, you mentioned the recent staff research that was done on housing, and one of those pieces of research showed significant growth in new mortgages from households with high loan-to-income ratios. I just wondered if you could speak to how your view of the risks around mortgages originated from households with high levels of debt and high loan-to-income ratios. How is your view around that changing, and how concerned are you specifically about that piece of the housing market?
Well, Kim, we will have more to say about that when we'll have a whole other press conference when we issue the financial system review. Today, really, the focus is on monetary policy. But what I can say is that a few weeks ago, we put out some analysis of what we're seeing in housing markets. And one of the things you do see is that there is rising loan-to-income ratios, sorry. So when you see people taking out bigger loans relative to their income, you worry that they may be overstretching. And as I said, in an environment where we've seen rapid price increases, there is a danger that people extrapolate those price increases. They expect that those will continue, and they overstretch on that basis. That's something that's worrying us. We are seeing some evidence of extrapolative expectations and speculative behavior. And as I said earlier, I think the proposal by OSFI to put a minimum qualifying rate in place will be helpful in that regard, because it'll protect, particularly in this low interest rate environment, it'll protect borrowers from overstretching.
And just as a follow-up, I wanted to ask about, there were a couple of references in the monetary policy report today to immigration and the role that might play in the economic outlook. And I think you mentioned in that immigration was lower than anticipated last year, but will be higher than expected this year. Can you just speak to what might be different in the economic outlook you presented today if it weren't for what looks like will be a sharp rise in immigration this year?
Kim, we were having a bit of trouble hearing your question. So I got it. It's about immigration. And can you just, what aspect?
Kim, maybe I can
sorry about that. Is this better?
Yes, that is
better.
much better.
Yeah.
Thank you.
Okay, sorry about that. So the question is, what impact, I guess maybe I'll just rephrase it a bit, what impact does the expected significant increase in immigration this coming year have on the economic outlook? And in the reverse, what would the economic outlook potentially look like if we weren't expecting that big increase?
So, through the pandemic, immigration, for obvious reasons, has been much lower than usual. That has been one of the factors that is reducing our potential output. It means our labor force is growing more slowly. We don't have new workers coming into the economy. The rebound in immigration is one factor that is contributing to the rebound in potential output growth. So it'll grow the supply of the economy. It obviously also grows demand in the economy. You've got more people working, that creates more income. They go shopping, that creates more demand. So that is that the increases in immigration that are projected by the government are built into our outlook.
Okay, the next and final question is from Greg Bunnell of BNN Bloomberg. Go ahead, Greg.
Yes, Governor, thanks for taking my question. I want to go back to July of last year, which obviously in many ways was a different time, but you did have a message for Canadians then. You said, if you've got a mortgage or if you're considering making a major purchase, or you're a business and you're considering making an investment, you can be confident that rates will be low for a long time. Given today's NPR, given today's outlook for the economy, if you had to update that message to Canadians, what would the update be?
Greg, my message to Canadians would be, I'd summarize it in 3 words: progress, time, and commitment. We're making good progress. Canadians and Canadian businesses have been impressively resilient to the pandemic. The outlook is looking better. Vaccines are rolling out, and there are brighter days ahead. And reflecting that, we have revised up our outlook. But second, time. It is still going to take some time to get to a complete recovery. This third wave is a setback. It is straining healthcare systems in part of the country. It will unfortunately particularly affect, once again, the hardest hit sectors and then the workers in those sectors. Important parts of the economy remain very weak. We have too many unemployed Canadians in this country. The third commitment, the Bank of Canada is committed to supporting Canadians and Canadian businesses through the full length of the recovery. And those were really the central considerations in our decision today to adjust our quantitative easing program and maintain the exceptional monetary stimulus.
Just as a follow-up, I want to say when I saw the decision today, when I saw the inflation expectations being pulled forward to perhaps hitting target by next year instead of 2023, just that idea of when you said you can be confident rates will be low for a long time, it felt like to me that statement, that outlook has changed, that sort of some people have taken as a low rate guarantee. Do you feel that it has shifted?
Our commitment from the beginning, Greg, has been with respect to our forward guidance, which, as I indicated earlier, it is an outcome-based forward guidance. We are committed to hold the policy rate at the effective lower bound until slack is absorbed to sustainably achieve our 2% inflation target. What we're doing, the good news today is that the economy has proven resilient. The outlook, vaccines are rolling out. The outlook is better. We think we're going to get back to a complete recovery sooner than we thought before. That's a good news story. That's what everybody wants. We've updated Canadians to reflect our latest outlook.
Thank you very much. Thank you, Governor. That concludes today's press conference. Thank you, everybody, for joining us today.
Thank you very much.
Thank you.